thank you very much for your time. And the results look strong, very positive, especially with regards to client activity. Clients seem to be more risk on globally. Where do you see that as being the strongest?
Well, results are very strong if you look at the first half year, strong if you look at the first quarter, and it's a combination of factors. For sure, when I look at client activity levels, have been picking up for already in the first quarter. There was entering into the new year renewed optimism by our private clients, which is indeed in contrast with what we see on the institutional side, where low volatility levels on almost all asset classes are affecting activities. So we see more deployment of liquidity, higher penetration of lending, higher penetration of mandates from our wealth management clients, and indeed there is a good momentum there. But
for the biggest wealth manager in the world, it's more important to see it on the private client side. Who is becoming more risk on? Is it Europeans? Is it Americans? Is it high net worth individuals, ultra high net worth individuals?
Actually, across the board. I would say that the very ultra clients and family offices have been catching up in the second quarter compared to the first quarter. But across the board, if you look at our Americas, our APAC business, and also in Europe, you saw pick up in transaction volumes and in general in all kind of activities in relation to deploying cash and in a more constructive way. Of course, clients are still somehow concerned about the macro environment and particularly about the geopolitical situation across the world.
So you have net new money globally, and in the U.S. I noticed a little bit of an outflow, negative. Why is that?
Well, we had very strong net new money for the first half of the year, and usually in the U.S. we see some outflows in the second quarter for our clients are paying taxes out of their assets, and there is a big component of that. But if I look across the board, very strong momentum. We had growth in our international businesses of 6.6% on a very high base. And this in contrast with the fact that we have been reducing client advisor headcount, so demonstrating that we can grow with quality. We are not focusing on quantity; we focus on quality, and we can perform in different market conditions.
I noticed cost cuts are obviously on track for 2017. You've got 1.8 billion francs of cost cuts or net cost savings already. The 2.1 billion looks easily achievable. Do you think you can overshoot that?
Well, easily achievable is not really, it's like a marathon. The last few miles are the most difficult. So I think that we are confident that we can achieve our target, but it's not an easy journey. Also because we are talking about a net cost savings target. So we are absorbing a huge amount of headwinds of costs coming in from unexpected regulatory changes, technology investments that we need to do to keep up our competitive position. So in order to offset all that, you need to work very hard on your actual cost base. But as I said, I'm confident we can get there by the end of the year.
So where do you see taking out that further 300 million? Are you looking at further CA reductions, or?
No, I think it's not a matter of headcount. It's across the board. What we focus on is optimizing our front to back infrastructure and enhancing productivity, and is a mix of different initiatives. When you get down at the last 10%, is really about every single dollar counts, and we are really focusing on the best. And of course, as I said before, we are also making a lot of investments. It's not just about cost cutting. I mean, cost cutting is not something that you can do forever. You cut costs in order to create also capacity to invest in the future.
You mentioned the institutional client activity slowing down. I noticed the pre-tax profit at the investment bank is down 6% in the second quarter. This isn't this isn't anything surprising considering what we've seen out of the U.S. banks, but when do you think that could pick up again? When do you think hedge fund clients will start to go back in?
Well, I think we are very pleased with the performance of our investment bank that delivered, despite all this market condition, a return of 18% on its allocated capital. So, of course, with volatility levels across all asset classes being so low, all institutional clients have been on the sideline, and until you see a little bit of a pickup there in volatilities, it's difficult to see a change in behaviors by our clients. We are also entering, we are in the middle of the summer time, and which is, from a seasonal standpoint of view, not the best time. But I'm confident. Most important for us is to show with our investment bank that under any market conditions we are able to perform, not only to shareholders but also to our clients, and this was the case also in Q2.
You had FRC. The FRC business was down, I think, 30%. Obviously, very tough comps considering Brexit was in the same quarter last year. But it's a huge portion of the business. Are you too concentrated on that?
No, I mean, if you look at our portfolio, we are well diversified. We have, but when you look at the FRC business, we are highly concentrated in FX. We are a top FX house, and 60% of our FRC business is in FX. And as I mentioned before, volatility level on all major currencies has been at the lowest ever levels, and therefore it's almost natural that you have less client activity, and I think that I would be probably more concerned about having much better results, consider the underlying conditions, since we are there to serve clients and accommodate execution of client businesses and not to do proprietary businesses.
Do you have any more clarity on where rates are going to go after what we heard from Janet Yellen a couple of days ago, considering what Mario Draghi is looking forward to, and then obviously the very unique position of what you have to deal with here in Switzerland?
Well, saying that I have more clarity is quite difficult in this environment, because if you go back in the last 4 or 5 years, everybody thought that we would have clarity in the incoming years with different hikes. Again, from the Fed, I do think that it is clear that the expected hikes that we had at the beginning of this year won't happen in the U.S. That doesn't mean that we won't see an adjustment of the monetary policy in the U.S. We will see how far the ECB will go. But there is still a lot of uncertainty, and of course, as I mentioned before, this uncertainty is also weighing on client activity levels.
But does it look like, for example, the ECB could begin to taper soon? Do you expect that, considering the inflation and growth situation?
I think that I'm pretty convinced the ECB will wait to see a confirmation of those trends, and probably will take a risk to take an error or on the conservative side, saying that there is a real trend on inflation and pick up before acting.
Let me finally ask you about Brexit. Always fascinating to see what banks are planning on doing. You say you're still considering Madrid and Amsterdam options, but you have so much infrastructure in Frankfurt already.
Yeah, but I think that we also need to build up different infrastructure, and at this stage it's premature to make a call on exactly what we will do. And the 3 options on the table are the one you mentioned, and we will take a decision late Q3, early Q4. But the good news is that we have a lot of flexibility, and we don't feel that we need to put pressure on the timing and find ourselves with having done some kind of regrettable moves.
What do you think, though, about ballpark figures? I mean, we're starting to hear from other banks about the size of balance sheet moves they want to make and headcount.
Well, I mean, in the last few months, we've been reducing the amount of options on the table. I think that the number of headcount at the end of the day will really vary on how much front to back you need to move, and And this is a consequence of not only your legal setup in London and in the continent, but also the kind of regulatory requirements and political solutions that will be found. So that's the reason I'm talking about not triggering regrettable moves, that you start to move or not move, and you find out after a few months that political solutions or regulatory solutions were found to minimize not only the economic consequences for banks, but most importantly, I think it's very important to understand what are the systemic and market distortion you may create by making moves that are not sustainable long term.
So you still have some optimism for a softer Brexit, at least as far as it impacts financials?
I'm optimistic that both sides will find a win-win solution rather than a lose-lose situation. I hope that ideology will not prevail versus a pragmatic solution that takes in consideration the needs of both parties.